On this 15-minute gold chart, a textbook bull flag forms. You execute the standard playbook, entering a buy order at the resistance breakout with a tight 20 pip stop loss below it. Suddenly, a massive spike drives the price down, triggering your stop loss by exactly 5 pips. Immediately, the chart reverses and rockets 200 pips to your original profit target. You were right, but still lost money. This experience is so common it has its own name: getting golded. Gold functions as a raw, unfiltered gauge of global sentiment and fear, a personality that differs from stable currency pairs like the euro. These spikes are engineered gold traps designed to hunt tight liquidity pools, your stop loss. They exploit gold's massive average daily range to shake out retail traders. Treating gold like a standard currency pair guarantees failure. To survive, you have to completely rebuild your strategy to account for extreme volatility. Before you even open a price chart, you need to check the macro weather. Institutional traders base their gold positions on two major leading indicators: the dollar index and U.S. Treasury yields. Because gold is priced in U.S. dollars, a stronger dollar makes the metal more expensive for foreign buyers to purchase, which drives its price down. The ultimate leading indicator, however, is the U.S. 10-year Treasury yield. Gold pays no interest, meaning holding it carries a financial opportunity cost compared to interest-bearing assets. This diagram shows the core rule of the relationship. When yields rise, investors can get a risk-free return on their money, so they sell off their gold to buy bonds. Yields go up, gold goes down. If Treasury yields are actively spiking, looking for long setups on gold is like trying to swim up a waterfall. That macro pressure renders any bullish chart pattern irrelevant. Once you understand the macro environment, you can adjust your technical execution. Start by filtering out market noise. This requires abandoning the 5 and 15-minute charts entirely in favor of the 1-hour and 4-hour timeframes. Look at this 4-hour chart. Single lines of support and resistance are replaced by institutional zones, shaded boxes that fully capture the long wicks of previous swing highs and lows. This leads to the core wick-proof rule: never enter a breakout early. You must wait until a full 4-hour candle body closes firmly outside the zone. This wait confirms the move, separating a structural shift from a momentary price spike. Only then do you enter on the retest of that zone. This prevents you from buying the top of a fakeout before the price pulls back. A good setup means nothing at the wrong time of day. Trading gold during the Asian session usually leaves you stuck in low liquidity, sideways chop that merely eats up your spread costs. The optimal trading period is the 13 to 1600 GMT window. This is the London-New York overlap, when massive institutional bank volume hits the market and sustains actual trends. During this heavy volume window, price naturally gravitates towards psychological numbers, like the 00 and 50 levels. Institutions use these areas as magnets for their take-profit orders. Combining a 4-hour zone retest with the massive volume of the London-New York overlap ensures you ride institutional momentum rather than getting crushed. The final, non-negotiable step is adjusting your risk. Even with perfect timing, gold's massive daily range will destroy your account if you use standard Forex position sizes. Because gold's range is so extreme, the rule is simple: you must cut your standard lot size by half or more to maintain your normal dollar risk percentage. Look at this comparison. This smaller position size allows you to use the wiggle room technique. Instead of placing your stop loss exactly at a structural low, you add a 20 to 30 pip buffer below the wick to survive the inevitable liquidity hunts. Absorbing this extreme volatility with smaller position sizes and wider stops is how smart money protects capital over the long run. Gold's volatility cannot be tamed, but by respecting its macro correlations and adjusting your execution parameters, you can turn its deadly traps into your greatest trading asset. Stop letting deep wicks shake you out of positions when you have the direction right. Open an FXNX demo account today to practice spotting these institutional traps and trading the London-New York overlap entirely risk-free.